For most children, filing an income tax return is far off in adulthood. But for a small group of children with a certain type of income, not only do they have to file tax returns, but they also might have to pay tax at a higher rate than would be expected considering their incomes. I'm the Tax Geek, and here is the Kiddie Tax, oversimplified. The tax on certain children who have unearned income, or as everyone outside the IRS calls it, the Kiddie Tax, was enacted in 1986. It was designed to keep parents from avoiding taxes on their investments by transferring their investments to their children. By shifting their investments to their children, parents could take advantage of their children's lower marginal tax rate since they had little or no other income. The Kiddie Tax originally only applied to children under age 14. Later, the age was raised to include all children under 19, plus children aged 19 through 24 who are both dependents and full-time students. The Kiddie Tax is only imposed on unearned income. As a brief recap, earned income is any income derived from either wages or active participation in a business. All other income, with very narrow exceptions, is considered to be unearned. Interest, dividends, and capital gains may first come to mind, but unearned income also includes rents and royalties, taxable Social Security, retirement distributions, and even unemployment compensation. Here's how the Kiddie Tax works. The usual standard deduction, or filing requirement, for a dependent is the total amount of their earned income plus $350, unless the dependent child has only unearned income, in which case the standard deduction is $1,150. Once the child's unearned income exceeds $1,150, the next $1,150 of unearned income, along with any earned income, is taxed at the child's marginal tax rate. Any unearned income over $2,300 is then subject to tax at the parent's marginal income tax rate, which is usually higher. As usual, an example is in order. Meet Carl and Dorothy. They are married and have a joint taxable income of $95,000, which puts them in the 22% marginal tax bracket. They have 3 children, Alex, Melissa, and Zach, all of whom have differing amounts of earned and unearned income. Alex is 17 and has a part-time job with earnings of $8,300, plus $75 in interest earned on his savings account. Alex's standard deduction is $8,650, which is his earned income plus $350. He is not subject to Kiddie Tax, has no tax liability, and is not required to file a tax return unless he has withholdings that need to be refunded. Melissa is 15 and has no earned income, but does have $1,950 in unearned income, consisting of $1,475 in bond interest and $475 in qualified dividends from investments left to her by her grandfather. Melissa's standard deduction is $1,150. She would have taxable income of $800, $325 of which would be taxed at Melissa's marginal rate of 10%, and $475 would be subject to capital gains rates, which in Melissa's case would be 0%. She is not subject to Kiddie Tax, but is required to file a tax return and has a $33 tax liability. Zach is 12, and his grandfather left him bonds which generate interest of $4,250 per year, which is his only income. Zach's standard deduction is $1,150, giving him taxable income of $3,100. The first $1,150 of that taxable income will be taxed at Zach's marginal tax rate of 10%, and the remaining $1,950 will be taxed at Carl and Dorothy's marginal tax rate of 22%. Zach is subject to Kiddie Tax, is required to file a tax return, and has a tax liability of $545. So how is all this reported on a tax return? Parents have 2 choices when they have a dependent child subject to Kiddie Tax. They can file a tax return for the child and include Form 8615 to calculate the Kiddie Tax, or they can, in specific circumstances, include the child's unearned income on their own return and include it in their own tax liability. In this case, any Kiddie Tax is computed on Form 8814. For a number of reasons I won't delve into here, it is almost always better for the child to file his or her own tax return and calculate the Kiddie Tax separately from the parents. Carl and Dorothy decided to do just that. First, Carl and Dorothy must calculate both their taxable income and Zach's taxable income and complete both tax returns through line 15. If the Zimmermans had more than one child subject to Kiddie Tax, their tax returns need to be completed through line 15 as well. Time to fill out the Form 8615. We start by entering the child's unearned income, subtracting the Kiddie Tax threshold, and comparing that amount to the child's taxable income. The lower amount is entered on line 5 and is tentatively subject to Kiddie Tax. Again, if they had multiple children subject to Kiddie Tax, their Forms 8615 would have to be completed through line 5 before proceeding any further. In Part 2 of the form, we list Carl and Dorothy's taxable income from their return, add the amount from Part 1 that is subject to Kiddie Tax, and figure the tax on the total. Then the tax on Carl and Dorothy's income is figured without regard to Zach's unearned income. The difference between the two is the amount of Kiddie Tax. In Part 3, Carl and Dorothy calculate the tax on the amount of Zach's income that is above the filing threshold, but below the Kiddie Tax threshold. This tax is added to the Kiddie Tax from Part 2 and compared with the tax on Zach's income as if it were not subject to Kiddie Tax. The higher amount of $545 is Zach's income tax for 2022. This amount is entered on line 16 of Zach's tax return and the return is completed. Yes, it can be confusing, and yes, it can be complicated, and has the potential of being far more complicated than Carl, Dorothy, and Zach's situation. In future videos, we'll look into electing to include the child's income on the parent's return, and what happens when multiple children in a family are subject to Kiddie Tax. You'll find links to additional information and resources in the video description. If you found this video informative, please give it a thumbs up. Subscribing to the channel and tapping the bell gives you immediate notification of new Tax Geek videos. And of course, your questions, comments, and suggestions are always welcome in the comment space below. Thanks for watching, and stay tuned for more of Your Taxes Oversimplified.